Do we have Lancelot and Rohit? Let's bring them in. Lancelot Dukuna is CEO, Crest Wealth Management. Lancelot, good morning. Good to have you with us here. Rohit is fund manager with Sharekhan. Rohit, good morning. Great to have you with us here as always. Rohit, first over to you. Your perspective on global markets, which are looking pretty strong, just 1.5% away from highs in the case of the S&P, and the market here as well, which has now crossed 7,900.
A lot of difference. I think US is probably the only market which is close to the highs that it's made before, and actually went back to that even in December, Jan, and then sold off from there. So the thing we are watching is whether those levels hold out or not. And at the same time, while you have seen some rebound in other global markets, none of them have gone up that much. So I think the US is a standalone case. You can pick up DAX, FTSE, CAC, you can pick up Shanghai or Japan, Nikkei. You can pick up any of those and you'll find that they are way, way far away from the all-time record highs that they were at. You can pick up odd markets like Russia also. So even our own market is not at all-time highs, but definitely we've retraced a significant portion of the last decline, coming back to 79.80 is almost an 80% retracement of the October to September sell-off. So that's pretty significant. I didn't think we'd get past 61%, which was at around 76.80 or so. So now the question is, what next? So the next level, of course, everyone will watch is closer to the 79.80 mark. But at 79.20.30, which is where we are now, you have the falling trend line from the all-time high, which is 9116, all the way down to around the 79.30 or 79.20. Range. So that level, unless we've really broken out of, we are essentially still in bear market territory. We are still heading down and we are at the upper end of the range. So my sense is this is a bear market rally, irrespective of how far it goes, and whenever it does stop out, and I think that could be sooner than later, we would see another turn lower, and that would be true, I guess, even for the US market, which has had a pretty strong run and has a lot of negative divergences as far as its momentum and volume are concerned. The move up has seen declining volumes and weaker and weaker momentum in each rallies based on the subsequent move, and so it's a matter of time, I think, that you see a turn down across world equities again.
But for now, if you're trading US stocks, for example, what would you do, Rohit? I mean, just hypothetically. Would you say,
buy to start with?
Sorry, go on.
Yeah, I wouldn't buy to start with, and the next thing is essentially where do you put in your sell trade. So we are waiting for that to confirm. We haven't gotten it yet, but I think we are very close.
So you're saying just forget about fundamentals or the lack of good fundamentals, etc. All that aside, even just purely based on technical indicators, you wouldn't go long the US market, for example.
No, I wouldn't.
Okay, and what would you do here, Nifty?
Here too, I'm looking at speaking out some of the sentiment readings have reached an extreme. Many of them had reached already a week back, and I got a couple more even on Monday. I got one more extreme reading. So when we are looking at these kind of readings, it means that you're at the top end of the range. And like I said, 79.30, the falling trend line, is also marking the top end of this range. So failure to get past this would essentially mean the start of another leg down. My sense is that something on the downside is still pending as far as our market is concerned, and the reason for that is the way the whole market has behaved in terms of index to index. You've had a 4-quarter decline in the Nifty, and you've had around a 5-quarter decline in Bank Nifty, and if you look at either 2008 or 2010 corrections in the market, both of them in either index 4 to 5 quarters was sufficient, but they also were accompanied by the broad market, that is either the mid cap or small cap index, also turning down for 4 to 5 quarters. That we have not yet seen. We are only down for 2 quarters or 3 quarters at the most for those indices. In most cases, like the BSE mid cap, you only have one negative quarter so far. And so my sense is you haven't had a meaningful correction in the broad market, which has been essentially the reason why you continue to feel that you're in a bull market and you're not in a bear market even after a 4-quarter decline in the key indices. So I think the broad market essentially has to give you that one sell-off or correction before you actually start looking for a bottom again. And that I think is missing, even though you did get a pretty sharp dip in Jan-Feb. It hasn't really pulled down the relative strength of the mid caps versus the large caps. And that remains a risk.
Okay, let's just come out of the wall, please, if we can. Let's just look at some individual stocks. So JSPL is up 3%. By the way, I think Credit Suisse has come out with an upgrade for the entire steel sector. I mean, actually, they're saying, well, the worst is behind as far as Indian steel sector goes. And actually, stocks are higher. Tata Steel is up 3%. JSPL is on your screen. JSW is also there. Suzlon is up 3%, if you can put that name up. Then let's look at HOEC. I think the reported results. HOEC is up 2%. We also have Lycos Internet, which is up 6% right now. I mean, it got to, it really rallied hard and it kind of fell hard, really hard as well. Nalco is down about 4% at this point in time. So this is the opening prices coming across different sectors, and I mean a couple of specific stocks there as well. 31 stocks higher, and the rest of the pack 19 odd stocks lower. That's still the tally on the Nifty 50. Commodity stocks, metal stocks are doing very well, and then of course HDFC Limited is doing well as well. Lancelot is with us. Lancelot, where do you stand on the market? You heard Rohit. He's pretty clear. He's saying he's not comfortable going long. I mean, what's your view? Near term.
Yeah, I think I would also agree with him on the overall trend, because we have seen the flows of FI flows actually been driving the market higher over the last couple of sessions, and that has been coupled with some good news about the monsoon, things like that. But it's a bit too early to say that yes, the economy is back on its track of recovery, because we are seeing some improvement in some sectors. But with the results that are coming in, it still appears that recovery is going to be a while away from a profit perspective of a profit growth perspective of various companies. So the kind of valuations that they are enjoying at this moment, it's factoring a much higher growth than what they're actually been able to provide over the next 12 months. So given that concern that you are seeing valuations in the light of growth being expensive, we could see some amount of correction whenever any negative news comes in, either on the global front or on the domestic front, and a lot of this enthusiasm could start beginning to sell off. So I think it's better to wait for corrections to really make investments and look at the quarterly numbers to see which of the companies are really turning around or reporting better margins and profits, and what the outlook is, given that this is a good time probably to start selling some of the higher valued or weaker companies and wait for a correction to buy into companies that will have better growth prospects going forward.
Which stocks or sectors you can point us to you think are prominent ones where you think there's a huge mismatch between what underlying prospects are and where stocks are trading? Where there's overvaluation, stock overvaluation.
I think if you look at sectors where to some extent the infra companies, they have all rallied up, and the engineering companies have rallied up in anticipation that orders will have started to flow, etc. But you'll find the valuations are a bit high compared to the actual execution on the ground, because whatever orders we've seen will take maybe another a year or so before you can start seeing that come into play on the earnings front. So I think some of these companies can be looked at for lightning positions, because they've rallied. At the same time, the fundamentals haven't been given, so especially looking at the engineering side, the mid-cap engineering space, where we can say that these are the companies that have moved up and we can look at cashing out of these.
Broadly infra though, right, Lancelot? That's what you're saying? infra engineering.
Infra companies are the ones which in every rally you can look at cashing out of these companies. Like in the morning we were looking at Bharti Infratel, for example. The stock was at 392 and it's now at 388. So it's sort of peaked out on valuations, and though there is a lot of news on the telecom side, on the ground level you're really waiting to see the deployment of a much larger network and how that is going to play into higher rentals for the company. Now, because you're not seeing the improvement in the revenues or the rentals per per tower, and you're not seeing the efficiencies going up, obviously now the valuations are peaked out. Until that time, it may be better to take advantage of this rally and lighten or reduce positions in something like this.
Right. You'd say the same for Bharti as well, although there are many who believe that Bharti is coming out of a long period of, actually post the global financial crisis, Bharti has been in a range, right? 200 odd rupee range. It's coming out of that now, and we'll see another leg of growth. It's very well poised irrespective of Jio and all of the other challenges.
Yeah, I think Bharti is very different from the Infratel space, because Infratel is the infrastructure space. I think Bharti is more it's been in a huge capex mode for a while. There were very large investments that needed to be made in spectrum, and now that they've completed the acquisition of spectrum across the footprint for competing with Reliance on the 4G front, I think strategically they have they're much better poised than what they were maybe a year back if Reliance Jio had launched. So considering that aspect, as well as the data consumption is really increasing, and with the smartphone the number of smartphones going out exponentially growing, I think the data consumption will only keep growing. So from that perspective, maybe 6 to 8 months down the road, they could reach the sweet spot where data would offset all the existing fixed costs, and you could get huge upside from there on. But it's a very long play, because the return on capital is going to be low, considering that they have to still deploy further capital. So in a company that keeps putting in more capital, valuations cannot immediately start to reflect this, because the return will take maybe another year or two to come in. So
what about
something that one can look at declines?
What about these housing finance companies? Again, the same overvaluation. You think you'll agree with that, or you think no, they're fine? LIC, grew, all these companies. Repco,
I think in housing finance, like you're saying, housing finance, microfinance are the areas where we've seen large, moves on these companies. And I think if you look at the top line growth, as well as because of the slowdown in the economy, we are seeing that the future growth is not going to be as fast as what it was in the past. So maybe with a trend of flattening growth curve for the housing finance companies, it doesn't then begin to justify higher valuations. Plus, from an interest rate perspective, I think net margins also would be close to their peak, because in order to increase market share or to increase volumes, the housing finance companies also have to drop their rates, which means that the NIMs have sort of peaked out, and we would start seeing the NIMs also becoming flatter going forward. So I think in these two sectors, again, you've seen the best is probably past us, and we could start seeing competitive pressures put pressure on the net interest margins, and that could reduce the valuation. So valuations need to then correct in order to make it an attractive point of entry again.
Fair enough. Rohit, agri, sugar, etc., that remains the theme for you?
Yeah, I don't think there's a change. Most of the agri price charts globally, which has been my underlying reason to look at, are all pointing up, and so I don't see any reason to change that in terms of an underlying theme. Though it can get affected by market movements in the near term, but I think higher agro commodity prices appear to be coming. So anything that benefits from that, we should be looking at.
Right. Anything else of interest, Rohit, to you? From stock or sector perspective?
I think one particular stock, Biocon, I think was making couple of moves in the last 2 weeks, and it's been one of the pharma stocks that actually didn't perform in the entire preceding period when pharma was doing so well, and it's been through a long consolidation phase. So my sense that sometime it breaks out of this range, and sometimes some pharma stocks can actually do well in a weak market environment as assets get reallocated. So I would like to look at Biocon as a potential trade for upside. But they are going to be very limited names. These are probably few that I've looked at. There may be few out there. But broadly, like I said, the broad market would probably be weak, so you need to be really, really careful about what you pick up and that your allocations remain limited. One of the sectors which overshot or is still shooting up right now that you need to be careful of is the metal space, which we were quite positive in Jan and Feb because it was looking like you'd get a rebound in metal prices. But that's more or less done. I think the rebound in stocks has also happened, and you've actually started seeing some sell-off in some of the base metal prices last week, though copper is still rebounding yesterday. But I think you need to be a little careful and watch whether the dollar sell-off actually continues to take a bet on metals again, because you were discussing earlier, crude is back at 41. It was at 41 at least twice in the last 2 weeks, and it couldn't get past that. So you need to see whether this commodity rally is now likely to turn lower, and whether the dollar is able to hold below the 94 level or not. So that would be an important trigger point for what commodities in general are going to be doing, because if you get a turnaround and the dollar index starts heading higher again, then you'll probably see commodity prices start to correct once more. So I think you need to be a little careful here and watch what these currency and commodity moves do over the next couple of days, and only then take a fresh call on that sector.
Okay, fair enough. Rohit, thanks very much for your time. Lancelot, appreciate you joining in. Good getting that perspective from both of you.